The world is about to run out of electricity. That's not clickbait, that's math. AI data centers, electric cars, factories going electric. Even heating, global power demand is compounding so fast that utilities are warning that the grid as we know it cannot keep up. We are walking straight into a structural energy shortage that will last not months, but decades. I'm telling you this as someone who actually allocates capital, not as a tourist. I'm an ex-financial advisor. I helped allocate over 10 million euros in assets for regular people across Europe, not hedge funds. I built a six-figure portfolio that's yielding north of 20% annually in just 3 years. And I don't sell one-on-one consulting or courses anymore. I build, I publish, and I show you exactly how I position for the next decade. And here's what most nobody in retail gets. The biggest winners of this AI era are not AI stocks. It's not some small cap cheap company you've never heard of. The real winners are the companies that produce, move, control, and monetize electricity. Because AI is not magic. AI is electricity, AI is heat, AI is physical infrastructure, nuclear plants, gas pipelines, high voltage transmission, steel towers, transformers, cooling, backup system, and grid rebuilds. If you don't own the infrastructure behind that, you are not investing in AI. You are just cheating for it. So in this video, I'm going to give you what I call the energy portfolio. 10 stocks to power the future. This is not a meme list. It's a collection of companies I consider long-term structural plays of the next 10 to 20 years of global electrification, AI power demand, and grid rebuild. We are going to walk through generation, transmission, fuel supply, and hardware. I'll give you the numbers, market caps, margins, depths, yield, PE, so you can understand why each one is in the basket. Then at the end, I'll give you a nuclear bonus section, how I would build a focused nuclear sub-portfolio, and what I think about the hype stocks in the SMR or Oklo will save the world narrative. And yes, we are going to talk about the risks because I'm psycho and not stupid. So welcome to Psycho Investor, where we don't just chase hype, we buy the infrastructure that powers civilization. Let's start. Here's the fact you have to internalize. AI data centers don't use a lot of electricity. They are on track to become one of the largest single sources of incremental power demand on Earth. We are talking about power-hungry compute buildings that pull gigawatts, run 24/7, cannot lose power for even a second, and need reliable, stable, clean baseload generation. Add on top of that electric vehicles, induction heating, electrified industry, heat pumps, crypto mining, and just normal economic growth. And the old utility model is already breaking. The grid wasn't built for this. The grid has to be rebuilt. And that's trillions with a T in spend over the next decade alone. That's not maybe. That is already being contracted. Utilities are budgeting tens of billions. LNG exporters are signing multi-year offtake agreements. Pipeline companies are locking in long-term volume contracts. Nuclear operators are negotiating direct power purchase agreements with hyperscalers, companies like Microsoft, at pricing power levels we literally never seen before. This is where you get in front of capital flows instead of reacting to them. I'm going to show you 10 tickers. Each role is different. Some generate power, some move fuel, some transmit it, some build the grid, some supply the equipment every single data center needs just to be allowed to turn on. Together, they form one story on the picks and shovels of the new energy race. Let's go name by name. Number 1, Constellation Energy. Ticker CEG. Constellation Energy is about 120 plus billion market cap company trading around 380 per share with a PE of roughly 35-37 times. I want you to hear this clearly. Constellation is the largest nuclear operator in the United States. That matters more right now than it has in 40 years. Here's why. AI needs 24/7 electricity. Not green sometimes, not maybe wind is blowing, constant, stable, zero downtime baseload. And it needs to be carbon free because of the biggest AI buyers, Microsoft, Amazon, Google, because they are publicly promising clean AI. That knocks out coal. That limits pure natural gas. That leaves nuclear. Nuclear is the only scalable, carbon-free, always-on baseload power source we actually have at the scale today. Constellation owns that. This is not a startup with a slide deck and a prototype reactor. It's live operating nuclear capacity. Margins, clean. Net profit margins in the 18 to 22% range. Return on equity often in the mid-teens, even touching 20% in strong quarters. That is elite in the utility world. Debt ratio around 16%. That's a pristine balance sheet for an energy company. Free cash flow, they're throwing off someone like 2.6 billion per quarter, not per year. Per quarter. That is a money printer, and that is where it gets psycho. Constellation has been signing massive long-term power contracts directly with hyperscalers. Microsoft and friends are not just buying energy credits, they are literally locking in future nuclear output. That is unheard of. That means high visibility revenue for years at premium pricing with a customer base that will beg to pay because they can't run ChatGPT on Vibes. They need electrons. Is it cheap? No. At about 35x earnings, you are not getting a bargain bin value play. You are paying for scarcity. You are paying for the only game in town. You are paying for a mode that isn't software. It's regulated nuclear assets that the world suddenly needs more than ever. In this portfolio, CEG is your nuclear baseload engine. It's the power plant. Stock 2. Vistra Corporation. Ticker VST. Vistra is roughly a 70 billion market cap name, trading around 190 per share with a PE near 27. And Vistra is interesting because it's not just a utility, it's a hybrid weapon. Vistra runs nuclear, Vistra runs natural gas generation. Vistra just acquired Calpine, the biggest natural gas plant operator in the United States. So instead of being stuck on the fuel type, Vistra sits on both. Reliable nuclear for long-term baseload and flexible natural gas for surge demand. Let me translate. If you have a heat wave, a cold snap, or an AI load spike at 3 p.m. on a Tuesday when demand goes vertical, natural gas peakers are what keep the grid from collapsing. Gas-fired plants can ramp faster than nuclear or renewables. The flexibility equals pricing power. Vistra is positioned for right now, today, immediate demand, but they are also positioned for the next phase where nuclear is the political darling of clean AI energy, because we all pretend we still care about net zero while also booting up 500 billion new GPUs. Financially, Vistra is not reckless. Free cash flow is strong, debt is higher than CEG, around 40 to 45% leverage, but a company running large-scale generation assets and integrating Calpine, that's completely workable. The important piece is that it actually spits cash and can scale. I call Vistra the bridge. They are the bridge between the fossil-dominated grid, where we still live on, and nuclear-heavy, AI-optimized grid where we're moving toward. You want to own the bridge. Then stock number 3, NextEra Energy, ticker NEE. NextEra is sitting at around 170 plus billion market cap. Stock price roughly in the low mid 80s. PE around 26. If you want renewable exposure, this is the adult in the room. Most people, when they say green energy, they buy solar panel manufacturers and then they cry because solar panel manufacturing is a cost race to the bottom, brutally commoditized, and margins get destroyed. That's not how you play the transition. NextEra is different. NextEra is the single largest renewable energy company in the world. But here's the important nuance. NextEra is not hoping renewables work. They already own the assets. They build, own, and operate utility-scale solar, wind, and storage at insane scale. And they are not just a renewable story. They are also a regulated utility. Florida Power & Light is theirs. That gives them stable, regulated cash flow. Translation, built-in predictability. Margins, strong. We're talking about 30% net margins in parts of the business. Free cash flow, over $1 billion per quarter. Multi-decade asset life, and they've raised their dividend for 30 plus years. This is not a meme. This is industrial grade cash compounding. The way I see NEE, this is how you get exposure to energy transition without gambling on which battery technology wins, on which solar brand survives. You're not buying the race, you're buying a racetrack. Stock number 4, Duke Energy. Ticker DUK. Duke is around a 90 plus billion market cap, trading in the high 110s to low 120s. PE about 20. I call Duke the boring monster, and I mean that as a compliment. Duke is one of the largest regulated utilities in America. That means something very simple. They are basically legal monopolies in their regions. The Carolinas, parts of Florida, parts of Midwest, you need power to get it from them. There is no competitor. You don't get to pick cheaperelectricityprovider.com. That doesn't exist at the scale in regulated markets. Now, here's where Duke gets really attractive under the hood. Duke plans to invest over $75 billion in the next decade to modernize and expand the grid. Read that again, $75 billion. Where does the money go? New transmission lines, hardened infrastructure, grid tech, capacity upgrades. Why does that matter? Because in regulated utility land, when they invest in assets, they are allowed to earn a regulated rate of return on those assets. In plain English, they spend, the regulator bakes their profit into your electric bill. Net margins, usually in that 13 to 16% range. Stable, predictable, you are not here for insane growth, you are here for controlled compounding. Dividend, roughly 4%, it's not even interesting, but that's cash in your account while you sleep. Electrification of cars, homes, and industry means more demand per customer. More demand per customer means more capital projects. More capital projects means more guaranteed rate base. Rate base means returns. Duke is how you quietly get paid by the fact that society literally cannot function without a power socket. Stock number 5, Xcel Energy, ticker XEL. Xcel is about 40 to 50 billion market cap utility trading around 80 per share, PE around 20. And Xcel is, in my opinion, underappreciated compared to names like NextEra. Here's what Xcel is doing. They are regulated utility serving millions of customers across the Midwest and Western US, and they are aggressively transitioning their fleet towards cleaner energy. Their stated target is more than 50% clean energy by 2030. So Xcel is basically the cheaper NextEra. You are getting the same model. Regulated cash flow plus renewable build out, but at a lower valuation and with a lower hype premium. They are not as big, they are not as famous, they don't get CNBC segments every day, but they are executing. Dividends yield sits around 3% and nobody cares about it. Cash flow are predictable, and most importantly, utilities like Xcel literally gets paid to rebuild the grid. That's the theme you need to internalize. When people say AI will need more power, what they are actually saying is utilities will spend tens of billions upgrading their grid, pass that cost to the end user, and lock in regulated returns for decades. You either get those cash flows or someone else will. Stock number 6, ONEOK, ticker OKE. Now we leave pure utilities and we get into pipelines. ONEOK is roughly a 40 billion plus market cap pipeline company trading around the high $60s to $70 range. This is where people who only ever bought tech get confused. So let me show this down because this part is critical. Natural gas is not dead fossil fuel from the past. Natural gas is the bridge fuel of an AI era. The power demand spike from AI isn't happening in 2045, it's happening right now. We do not have enough nuclear built to meet it. Wind and solar are intermittent. So how do you keep the lights on today while pretending you are transitioning to clean baseload tomorrow? You burn gas. What does ONEOK do? They move that gas. Pipelines are toll roads. Think about a highway. Cars go through, you collect tolls. ONEOK is the toll collector on natural gas volume. They don't have to bet on commodity price the way a driller does. They care about throughput. Financials? They generate on the order of $1.4 billion in free cash flow per quarter. Net margins float around 11%. Leverage isn't crazy for midstream, and they pay you a huge portion of that as dividends payout ratio can get up in the 80, 90, and 100 range. People see that and panic, but midstream is built for high payout. It's part of the value proposition. The story here is incredibly simple. AI needs power today. Today's fast power is natural gas. Natural gas flows through pipes. Those pipes pay you. Stock number 7, Cheniere Energy, ticker LNG. Cheniere is about 45-50 billion market cap company trading around 220 per share and PE near 18. And if you want to understand why this is one of the most structurally advantaged business models in modern energy, watch this. Cheniere exports liquefied natural gas from the US to the world. The US sits on ridiculously cheap natural gas. Europe and Asia do not. So Europe and Asia are basically betting to import US gas. Who stands in the middle and takes a cut? Cheniere. Let's talk profitability. Net margins around 30 to 35%, operating margins above 50. That's insane. That's software level margin in a physical commodity business. Free cash flow over 1.5 billion per quarter, and the balance sheet strong. They've been deleveraging and securing long-term contracts with international buyers that lock in revenue visibly for years. Here's the thesis. Global LNG demand is expected to keep growing at around 5% plus a year as countries either get off coal, diversify away from politically unstable suppliers, or just try to stay alive when Russia turns off a pipeline. AI-driven electricity demand in the US pulls gas usage higher domestically. Yes, but the bigger story is that US gas is underpriced globally. Cheniere arbitrages that. It's the exporter. They move American gas into high-priced foreign markets and capture the spread. At about 18x earnings, Cheniere is one of the most attractively valued names on this list relative to strategic importance. This is not hype. This is cash. Stock number 8. Enterprise Products Partners, ticker EPD. Enterprise Product Partners is about a 60+ billion market cap master limited partnership, MLP. Trading in the low 30s per unit, PE is around 12. Now we are getting into true income territory. EPD is not sexy. It's not supposed to be sexy. EPD is quietly one of the most reliable cash distribution machines in North American energy infrastructure. What does EPD do? They own pipelines, storage, processing infrastructure. They are the logistics network for oil and gas liquids. Think of EPD as the midstream backbone. When volume moves, they clip a fee. It's boring. That's why I love it. Financials, free cash flow in the ballpark of 1.1 billion per quarter, net margins low teens, very steady, and here's the part dividend investors care about. Yield. You are looking at income in the range of around 7%. That's interesting. And remember, MLPs are tax-advantaged structures. They distribute a large portion of cash back to unit holders. This is a different animal from a growth tech stock. This is the slow, relentless, boring cash engine in the portfolio. When you build an energy infrastructure basket, you don't just want growth. You also want something sending money back to you now, and EPD is that. So you can reinvest it further. Stock number 9, Eaton Corporation, ticker ETN. This is where we leave fuel and generation and move into hardware. Eaton is about a 100+ billion market cap company trading around $370 per share, and yes, it's expensive. PE around 36. Now let me explain why it's worth paying out. Everything we are talking about, data centers, AI clusters, EV charging corridors, upgraded grids, hardened transmission, all of it needs physical electrical components, power management, switchgear, circuit protection, backup system, cooling support, distribution panels, industrial scale, everything Eaton makes that. Margins, very healthy, net margin in the mid-teens, around 14 to 16, operating margins around 18 to 20, free cash flow in the billion per quarter range, and Eaton is global. This is not a US-only play. When Europe upgrades its grid, Eaton is there. When Asia builds out EV infrastructure, Eaton is there. When hyperscalers build new GPU farms, Eaton is literally in the room speccing the guts that keeps those servers alive. This is the picks and shovels play. You don't have to know which AI company wins. You just have to know that every AI company needs power delivery infrastructure that won't melt. Eaton is the company selling that shovel. Yes, 30x earning is not cheap. You are paying for position. You are paying for inevitability. Stock number 10, Quanta Services, ticker PWR. Quanta is about a 60+ billion market cap company trading around 430 to 440 per share with a PE around 60. And I'm going to warn you right now, this one screens as overvalued if you only look at the traditional valuation. But that misses the point. Here's what Quanta does. Quanta builds the infrastructure, high voltage transmission lines, utility grid hardening, pipeline construction, renewable hookups, data center interconnects, the literal physical build out. When Duke or Excel or Nextera say we are going to invest billions into transmission and grid modernization, who do you think is getting those contracts? When the US talks about needing a complete rebuild of the aging grid, who is called to actually climb the poles and bury the lines and fix the substations? When LNG export capacity expands, who builds the connective tissue in the field? That's Quanta. The margins on paper don't look elite. Net margins around 3 to 5%. That's low, but that's because Quanta is a throughput business. They are volume. They win by having a gigantic multi-year backlog of work. Multi-year visibility matters more than individual project margin, because what you are really buying here is guaranteed demand. Utilities and governments are basically saying, here's the next decade of work lined up in advance. Please just execute. Free cash flow sits in the 300 million per quarter range. And yes, 60x earnings is spicy, but this isn't a meme 60. It's we are about to see $1 trillion grid rebuild, and we are one of the only scaled specialists who can actually do it. 60. Quanta is how you own the execution layer of the energy transmission, of the energy transition. Now you ask for 10 stocks. You've got them. CEG, BST, NEE, Duke, XEL, OKE, LNG, EPD, ETN, and PWR. But we are not done, because if we stop here, we're missing the thing that could define the next 30 years of power. Let's talk nuclear. Let's talk SMRs. Let's talk about what's real and what's hype. So let's get to bonus section, nuclear and SMRs. So nuclear used to be boring. Now nuclear is the savior of AI. Every politician who couldn't even spell uranium 2 years ago is now talking about building small modular reactors in every industrial park. Wall Street hears that and instantly tries to sell you whatever stocks has nuclear in the ticket. Don't fall for that. We're going to split nuclear into two buckets: operational nuclear and speculative nuclear. So operational nuclear means it already exists, it's already generating power, and it's already making money. This is Constellation Energy, this is Vistra on the nuclear side. This is the stuff that keeps data centers running at 3 a.m. tonight. This is what hyperscalers are literally signing contracts for right now. Speculative nuclear is SMR, small modular reactors. The dream is beautiful, factory built, smaller, cheaper, safer nuclear reactors you can drop next to a data center on an industrial facility. The problem? Most SMR plays are pre-revenue science projects asking you to pay today for profit maybe in 2032 or 2035. That's not investing, that's venture. Let's walk the players. Let's start with the hype stock everybody loves to say in the future of clean AI power. Oklo, ticker Oklo. Price around 140, market cap around 24 billion, revenue zero, not low, zero, no operating reactor, no commercial reactor build, no approval from the US Nuclear Regulatory Commission for a working unit. They are burning cash, and the entire valuation is basically people betting that Sam Altman built OpenAI so he can build a nuclear too. Could it work? Sure. Could it become 100 billion someday? Yes. Could it also go to zero? Absolutely. You are paying venture capital pricing in public markets. That's not a core position. That is a lottery ticket. Then you have NuScale, ticker SMR, price around the high 30s. NuScale is important because they are the first SMR designed to actually get NRC approval in the US. That's not small, that is moat. But here's the dark side. They are still unprofitable and massively. Revenues are tiny and largely consulting and engineering, not commercial reactor output. And they've had major project delays. One of their flagship utility partnerships, Utah, fell apart. Net margins are like negative 200% operating margins negative 400%. They are burning over 20 million in cash per quarter. So again, yes, regulatory approval is real, but execution has been brutal. You can 10x if they finally built one that works. You can also bleed for years while they try. So then you've got companies trying to brand around microreactors. Some are actually generating revenue today, but that revenue is not yet from commercial SMR deployment. It's from adjacent businesses they've acquired. So the nuclear story is still someday. This is why I don't tell normal investors go all in on small modular reactors. The timeline risk alone can kill you. First commercial deployment may not realistically happen at scale around 2030 or later. That's political risk, regulatory risk, technology risk, financing risk, supply chain risk, competition risk, all stacked on top of each other. So here's how I play nuclear in a way that is aggressive but still sane. If you want nuclear exposure as a focused sub-portfolio instead of throwing darts at pre-revenue science fiction, you build something like this. Constellation Energy, about 30% of your nuclear sleeve. Cameco, around 30%. Cameco is not a utility. Cameco is uranium. Cameco is one of the biggest publicly traded uranium producers in the world. They own Cigar Lake, one of the richest uranium deposits on Earth. Uranium is the fuel for every nuclear reactor, including SMRs, if they scale. Cameco's revenue sits in the hundreds of millions per quarter, growing fast with net margins that can explode north of 50% when uranium pricing tightens. You are not betting on which SMR company wins. You are betting that all nuclear needs uranium and uranium supply is constrained. That is a beautiful commodity squeeze story. BVX Technologies, around 20%. BVXT is the arms dealer. BVXT builds nuclear components for the US Navy, submarines, aircraft carriers, under government contract. That is steady, predictable defense-backed revenue. They are also positioned to provide components that fuel system for commercial SMRs. So again, you are not betting which SMR brand wins. You are buying the company that supplies whichever SMR brand survives. BVXT does hundreds of millions in quarterly revenue with double-digit net margins and real cash flow. PE is under mid-40s, which sounds high, but you are paying for certainty in a field full of science projects. Vistra, about 5%. Why include Vistra? Because they give you nuclear exposure that's already in operation, plus natural gas flexibility, which is how power is actually managed in the real world while we wait for SMRs to be real. And if and only if you want lotto tickets, you layer a tiny amount onto NuScale or Oklo or both. I'm talking 5% each or less of that nuclear sleeve. That's not 5% of your net worth. That's 5% of your nuclear allocation. The difference between investing and gambling is position sizing. I'm not saying never touch them. I'm saying don't lie to yourself about what they are. Because here's the truth nobody admits out loud. SMRs are not an investment today. They are promise, and promises are not a retirement plan. Real nuclear exposure is kind you can actually build wealth on. Comes from three places. Operators who generate cash now, Constellation Energy, for example. Suppliers of critical fuel, CCG, and component manufacturers who get paid no matter which SMR brands wins, BWXT. Everyone else, you size like you are buying a call option on the future of civilization, because that's what you are doing. Before I close, I want to give you the part most YouTube finance channels conveniently skip. The risk. Number one, this is still equities. These stocks move. Quanta can drop 20%, Constellation can get hit by sentiment and drop 30%, LNG can get crushed if global gas prices collapse or Europe starts posturing politically. This is not a saving account. If you panic sell because something is red this week, you don't deserve the 10-year payout. Number two, political risk. Nuclear is having its PR comeback arc right now. Great, but politics is emotional and inconsistent. A single incident, even a minor one, can create knee-jerk regulation. Natural gas can get taxed to hell if someone needs to be tough on fossil fuels on TV. You have to accept that energy is policy-driven. Number three, interest rates. Utilities and infrastructure companies are capital intensive. They borrow to build. If debt stays expensive, growth gets slower and returns take longer. That's fine if you're long term. That's not fine if you're treating this like a 3-month trade. Number 4, overconcentration. Do not put 90% of your net worth into energy because somebody said AI needs power. I'm telling you where the secular tailwinds are. I'm not telling you to stop being diversified. In my view, a portfolio like this makes sense as a core theme, but it still sits alongside other exposure like tech, cash flow assets, and yes, if you cycle like me, Bitcoin. You build a barbell, not a monoculture. Here's how I would personally think about sizing. If you are building a long-term wealth portfolio, this energy portfolio, the 10 stocks basket we've just walked through, could be, for example, 20 to 30% of your total investable assets, if you believe in the thesis. Within that sleeve, you are diversified across generation, transmission, fuel equipment, and construction. That's how you get paid if AI melts the grid. EV adoption keeps climbing, governments finally wake up and throw trillions at infrastructure, and nuclear quietly becomes the most valuable real estate on Earth. Let me leave you with this. Most people buying AI exposure are not actually buying AI. They are buying whatever trending on TikTok. They are chasing software multiples on companies that may or may not be around in 5 years. Meanwhile, the companies we just talked about are the ones physically powering the entire thing. Nuclear operators with billion-dollar quarterly free cash flow. Regulated utilities with guaranteed returns baked into your electric bill. Pipelines that function like toll roads. LNG exporters with 50% operating margins selling American gas to Europe and Asia. Electrical infrastructure suppliers selling directly to the data center arms race. Engineering firms with multi-year booked backlogs to literally rebuild the grid. This isn't a hype story. This is civilization. This is how the modern economy continues to exist. You asked for 10 names, you got them. And then, in the bonus nuclear sleeve, I gave you some more. If this opened your eyes, you are my kind of investor. Subscribe, hit the notification bell, and tell me in the comments which part of the portfolio shocked you the most. Was it nuclear? Was it pipelines? Was it grid build-out? I read what you write because this channel is built for people actually trying to get financially independent, not for people playing pretend rich or social. This is Psycho Investor. We don't wait for permission. We build positions, we collect cash flow, we let compounding do the violence for us. Stay focused, stay aggressive, and stay psycho.